For more on all things Fed, including this story, let's welcome in Mohamed El-Erian. He wrote an op-ed in the FT today saying the new chair is being misread. Mohamed is Allianz's chief economic advisor. It's good to have you back. We'll get to your op-ed in a moment because I certainly want to do that. But your reaction to this news of the day, this continued effort to try and get rid of Lisa Cook?
It's puzzling. Interestingly, the market didn't react, Scott. Nothing moved really in the fixed income market when this news came out about an hour ago. And I think part of it is because the market is comfortable that the new Fed chair believes in Fed independence, has the ability to convince people on the FOMC, depending on how he assesses the situation. So it's interesting that unlike the first time, there's been virtually no market reaction at all to this.
Sure, but I mean, while the Fed chair himself may believe in Fed independence, it's clear that the president may hold a different view on what his role could and should be on that very question. And if nothing else, this just simply throws that question back out there for people to discuss and debate as almost a distraction from the Fed's job at hand.
That is certainly the risk, Scott. But we've already seen one round of this. It's a bit like the tariffs. We've already seen one round of this. It turned out that Fed independence is quite strongly anchored. And I think the market feels, and I agree with the market, it feels that the Fed can protect its independence, especially if it embarks on the types of reforms that Walsh is committed to.
So let's move from the question of its independence to questions that are sort of hanging out there otherwise. You wrote an op-ed in which you say that the Walsh is being misread. In what sense?
So there are three areas. One is, do we need the sorts of reforms and do we need the task forces that he's put in place? And I think, and you better judge, but I think consensus has moved that the reforms are a good idea to look into and that the task force are populated by people that are highly respected. The second issue was forward guidance and his refusal to submit dots. Again, we're seeing consensus move towards, you know what, maybe it does make sense to not provide forward guidance when the world is so fluid. And we talk about it every day. Geopolitics, AI, there's so much going on that this notion that you can have accuracy going forward doesn't make sense. The third area that hasn't moved as yet is his reaction function. And that's because of the press conference. If, however, you go back to his speeches, you go back to his testimony in front of Congress, you go back to his confirmation hearing, there is a very clear reaction function where interest rates are the main weapon to combat inflation and keep an eye on the supply side as well. That's his two very big reaction function elements right now.
So it's one thing to get rid of forward guidance and get rid of the dots. I think everybody can agree on that. Isn't it a different thing, though, to completely refrain from giving any sort of explanation to the market on what your thinking is, on how you're going to do what you say and pledge and promise that you're going to do? And that's get inflation back down to target and then suggest that there's zero tolerance for anything otherwise, but not to give the market anything to understand how you're actually going to achieve that goal.
So that line that divides reaction function from forward guidance is seen differently by different people. And that's the issue. The FT ran a story that seemed to have been well sourced that maybe at Jackson Hole, we're going to get closer to what you're looking for than where he was at his press conference. I think it's amazing that we've had inflation running hot for 5 years. And you've heard me complain about this over and over again and complain about the other slippages. And people were quite tolerant of this. And now suddenly people have become less tolerant, even though core inflation has not moved up in any significant manner. And I think that It's just the change of the Fed chair and people getting used to a very different way of operating.
There's no question about that. And look, the bond market, for one, is going to have to try and figure it all out. I'm wondering if there is a, in quotes, cost of the Fed chair's own uncertainty in his messaging. And that's in part what we've got with the 30-year backing up to the degree it did as he was speaking last week. And it's continued to remain at relatively, the same similar levels, albeit a little bit lower today on what was the disappointing jobs report.
Okay, so first of all, inflation break-evens haven't moved. And if there was a loss of credibility of the Fed, you would have seen that happen. Secondly, what's happening to the long end, and you talked about it this morning, has mostly to do with the incredible amount of demand for loanable funds. You and I talked about this. I did a very simple exercise 2 to 3 months ago, and I wrote about it, where, like the good old days, you would look at the uses of funds, you would look at the sources of funds in the bond market and ask, do they equilibrate? And they don't, because the uses of funds are going enormously higher. Look at simply what Alphabet has been doing. There's $800 billion of capex that needs to be funded. There are government deficits. And then on the sources side, the Gulf is no longer a main provider of capital like it used to be. So that is going to have an impact on the 10-year. It's going to have an impact on the 30-year, and it has been having that impact. And that's why the 30-year is stuck around 520, despite everything else that's going on.
Do you think the wait-and-see crowd was vindicated in any way by today's jobs report, if you take that in total with the last month and then the revisions that we got as well?
Yeah, and you saw a 10 percentage points move in market expectations down to 43%. Having said that, next week, the CPI and to a lesser extent, the PPI, that's what's really going to move Fed expectations with regard to September.